Richard Harris joining us this morning, Chief Executive, Port Shelter Investment Management. Richard, a very good morning to you from where we are here in our Mumbai studios. Great to have you as always. Just want to get your sense on the US-China framework that's being talked about. Who comes off better in this deal?
Too early to say. We've had a lot of talk. We do tend to get the American side talking a lot. We get the Chinese side talking not very much. Very often they come back with something a lot less emotional after 2 or 3 days. So we really have to see. I do find Secretary Bessent is very much a jam tomorrow kind of guy. And in a way, he has to do that because that's what Secretaries of Treasury do. They don't want to spook the markets. I think it's almost inevitable that both sides will come to some sort of agreement that they can live with. They both upped the ante before the talks, the Chinese with rare earths and soybeans, the Americans with threats of 100% tariffs. I don't think it's a particularly good way of negotiating because both parties go into negotiations looking to come down from a much higher position. So I think we will end up with tariffs. I think we'll end up with tariffs higher than we are now. Nothing like the extreme ones that we've seen before. But let's face it, compared to 12 months ago, much higher.
Richard, morning. All of this is happening at a time when there is a little bit of uncertainty for the US with regard to data back home. And you have the government shutdown that continues 26 days now, and it's heading towards the longest ever. The question is that with that inflation data that you saw on Friday, it was softer than expected, perhaps enough for the Fed to pull the trigger on rates and go lower. At least that's the expectation. But in this swirling uncertainty on data and the direction that US debt is going to take, how would international investors like yourself position themselves? Would you reduce your exposure to the US, perhaps look favorably towards India, where you have short covering that is in effect already?
Well, I think the thing about the US, although it's a market that maybe still doesn't look too bad, we're looking at more muted inflation. We're certainly a bias on lower interest rates, and the markets do seem to want to keep moving up. Let's face it, anybody who's been invested in the US has done extremely well. It probably is time to take profit, certainly for much of the year. I've been looking to take the top off, say, some of the stocks in the US that have done very well and shifted principally into China because China had underperformed. And as we've seen this year, China's actually done very well, especially the Hong Kong markets, which reflect the bigger Chinese companies. But also, I think that investors are looking elsewhere towards Southeast Asia, towards India. The one thing about India, of course, that foreign investors think is that, well, India's had a fantastic run over the last few years. We're seeing a bit of a slowdown this year. That's not terribly surprising. So I think that probably the principal focus will be, if you're looking at emerging markets, will be towards China, towards Southeast Asia, and then towards India. That doesn't mean to say that India isn't a great investment. It's just the psychological impact of having a market that's done so well over quite a number of years, I think probably means that investors are going to see where they can pick up value elsewhere, and the Chinese market is still very cheap.
Okay. Richard, just one final point. We were talking about oil, and what do you reckon happens there if the trade deal is reached? Because US has shown its propensity to increase supplies every single point of time crude oil goes above 60, right? The whole of the shale and the other factors come into play. Do you think upsides are capped here, even if the trade deal were to be reached and growth expectations lift off?
Well, I think the analysis you had between you just now was exactly right. So I'm pleased you agree with me. It does look difficult for oil really to have a spike up. I mean, if we haven't with the war continuing in Ukraine, if we haven't seen it with the US putting pressure on China and India to reduce buying oil from Russia, I think that, we're probably, there's unlikely to be a spike. I think it's likely to be where it is now. I think a couple of things to remember about oil is that the exports from Russia, of course, are quite expensive. Just the sheer process of getting it from Russia to refineries and other parts of the world is difficult because a lot of these Russian tankers are under sanctions. That probably costs maybe 10% on the price of oil. So if you're looking at getting cheaper oil, well, you're probably not going to bother unless it's more than 10% cheaper. So you're looking at the Russians having to sell at least 20% below market. And even there comes a point at which is a point of no return. So I think that the pressure that the US is putting on other countries will certainly take the edge off purchases from Russia. They won't do it entirely. I don't think US shale pumpers will come in at this sort of level. They probably need 80 or 90 before they get interested. But there's still plenty of capacity in the Middle East. So yeah, oil looks as if it's probably stuck within this range, maybe $10 higher. Although very often we're surprised and it might be $10 lower.
Richard, thanks so much for taking the time. Pleasure speaking with you as always.
Thank you. Thank you.